Hello, and welcome to Financial Foundations for Success. In today's session, we're focusing on something that can change the entire game of your business: a special relationship, but not just any relationship, your relationship with your bank. Building banking relationships. Our subtitle is simply Banking on Relationships, because truthfully, your success isn't just about how much money you make. It's about who you can call when you need to move that money, grow that money, or even protect that money. When you've got a real connection with your financial institution, you're not just a customer, you become a partner. There's another level beyond knowing what a checking account does. It's about understanding how real, intentional relationships with your banker can unlock funding, help you weather hard seasons, and elevate your business to the next level. Let's dive in. By the end of this session, you'll understand why banking relationships matter and how neglecting them can come at a cost. You'll know what banks look for, who you should be connecting with, and how to use your business accounts as strategic tools. We'll also walk through available small business banking products and unpack the power dynamics that determine who gets a yes. You'll walk away with a clear game plan to confidently engage with your banker, present your business in a compelling way, and build a relationship that becomes a long-term advantage for your business. Why the business banking relationship matters. In today's fast-paced market, having a banker who knows your story means loans get approved faster, terms become more favorable, and you gain a trusted advisor when cash flow tightens. I've seen entrepreneurs with spotless credit struggle for months over an online application, only to get a warm introduction and approval in days when they walked into a local branch with clear financials and a handshake. Building that human connection is the difference between chasing capital and attracting it. In the words of Warren Buffett, the most important word in the world of money is trust. So always remember, people do business with who they trust. And that's a note that you should remember as a business owner for your customers, as well as when you go into the bank and think how the bankers think. The cost of no relationships. When you treat banks like anonymous vendors, you pay a price. Without a champion inside the institution, you face slower decisions, higher interest rates, and limited credit options. Some clients have gotten stuck in underwriting limbo because their loan application submission lacked context. Even worse, in a downturn, you have no advocate to negotiate extensions or emergency funding. The absence of trusted banker can stall expansions and leave you scrambling when opportunity or crisis strikes. The goal is always for you to be prepared as a business owner. That preparation includes having the professional advisor available when you need it. What banks look for. Banks analyze 5 key factors before extending credit. First is character. Your character reflects your reputation and credit history. Lenders review your payment records, outstanding obligations, and how reliably you've met commitments. Second is your capacity. With capacity, banks examine your debt-to-income ratio and cash flow. You must demonstrate enough consistent revenue to cover both existing debts and new loan payments. Third is capital. For capital, banks measure your reserves, such as savings, investments, and even equity, that you can deploy towards repayment. Larger contributions often unlock better rates. Fourth is collateral. When banks look at your collateral, they're assessing what you have as assets for a pledge. Things like real estate, equipment, or inventory as security. Assets can give lenders comfort that they can recover value if you default. Finally, are conditions. Assessing conditions consist of the bankers analyzing the loan's purpose, industry health, and economic climate. Banks consider whether your sector is stable and if your business plan aligns with broader market trends. It's important to keep in mind that presenting detailed financial statements and a realistic growth trajectory against these criteria can transform you from an applicant to a desirable partner. Types of bankers to know. Within most institutions, you'll encounter several roles that work in concert to serve you as a business client. A business banker manages your day-to-day needs and is your first point of contact. A commercial loan officer handles larger credit requests and structures complex financing. A branch manager can expedite decision-making and champion your file internally. A treasury services representative advises on cash management tools, helping you to optimize receivables and payables. Finally, an SBA lending specialist guides you through government-backed loan programs, especially if their bank holds a preferred SBA lender designation, which means that can make the difference between expedited approval and a referral to the SBA for underwriting. Keep in mind, this list is not all-inclusive. Also note, roles, responsibilities, and titles may vary with each financial institution. How to build and maintain banking relationships. Start by setting up separate business checking and savings accounts. Make sure each transaction is recorded clearly in your bookkeeping system to make audits smoother and help you make smarter financial decisions. Schedule an in-person introduction to share your business plan. Articulate both short and long-term goals. And demonstrate how you intend to generate profit that exceeds any amounts borrowed. From there, keep your banker in the loop with quarterly updates. Invite your banker to milestone events and request an annual financial review. Celebrate your business successes with your banker and approach any call proactively rather than only in emergencies. With many businesses, these touch points can become opportunities to brainstorm growth strategies, negotiate better pricing, and secure emergency lines of credit before they're ever needed. Using bank accounts strategically. First things first, ensuring separation of personal and business accounts isn't just best practice. It actually protects your personal assets and strengthens your professional image. Clean, organized transaction histories simplify tax filings, support audit readiness, and enable you to leverage account patterns for better creditworthiness. Automate savings, bill payments, and transfers to maintain healthy cash reserves and avoid late fees. Aligning your banking tools with your financial rhythms builds a track record of stability that banks reward with higher limits and lower rates. Understanding the power dynamics. Banks fundamentally assess risk, and your preparation directly reduces their hesitation. Cold online applications lack context. A banker who knows your mission and cash flow model can advocate on your behalf. Your narrative matters as much as your numbers. When you present a cohesive case, that means your business plan, your metrics, your market insights, and your management team, bankers move from passive approvers to proactive champions. Cultivate that relationship, and you gain access to tailored solutions and significantly increase your odds to products or services you didn't even know were available. Small business banking products. Selecting the right banking products fuels your growth. A rewards business credit card can effectively subsidize travel expenses like airline tickets, hotel stays, and car rentals if you negotiate generous points or cashback structures. Lines of credit, whether secured or unsecured, offer flexible access to funds for seasonal inventory or working capital needs. Term loans and SBA backed financing supply lump sums for equipment purchases or real estate, especially when your banker holds a preferred status that accelerates underwriting. Merchant services, from card processing to integrated invoicing and POS systems, scale your business to collect payments and enhance customer convenience. Tools for relationship health. Now, we've covered quite a bit of information, some of which requires some form of tracking for maximize efficiency. Keep things organized by tracking your bank meetings. Whether it's a notebook, spreadsheet, or an app, jot down the date, who you met with, what you talked about, and any promises or follow-ups. That way, nothing slips through the cracks while you demonstrate how you move like a boss. Along with your tracker, keep a simple quarterly checklist to review your financial health and a detailed log of your communications with your banker. A short monthly summary of your account activity, showing what's moving, including any questions or concerns you have, turns each conversation into a powerful opportunity, not just a routine check-in. Implementing these simple tasks drastically improves your bankability and, most of all, your relationship with your banker. Call to action. Whether you already have a business account or are just getting started, take action today. Identify a bank you want to build with. Or, if you've already opened one, reflect on why you connected with that institution and pinpoint your primary contact. Schedule a short 15-minute check-in. Take a moment to organize your most recent financial records so your story is clear. And finally, set a relationship goal for the next 90 days, even if it's as simple as making a second follow-up. Your financial future is shaped by the connections you build today. So start planting seeds right now. Final thoughts. Be intentional in every conversation. Communicate with clarity and confidence, and treat your banker like any other critical stakeholder. Your dedication to preparation and transparency will establish you as a valued client and not just another line on their ledger. Well, that's it for today's session, and thank you for attending Banking on Relationships. We look forward to having you in the next session when we'll discuss liabilities, business designations, and insurance coverage.